It is 8:47 a.m. Pacific Daylight Time. It is the second day of July 2025. This is episode 1125 of Bitcoin, and we got lots to cover today. We got a Celsius lawsuit that has been allowed to move forward. That one's going to be against Tether. It looks like the knives are out. It's maybe the night of the long knives. Who knows? And then we got a UK pension firm that is seeing growing interest in Bitcoin. And I think that the following is going to be the most interesting. We're going to talk about Figma. And if you don't know what Figma is, you will in a moment. Arizona and Connecticut decide to commit suicide. It's just going to be awesome for them. Deutsche Bank is back in the news. I talked about him yesterday on a completely different subject. But now Deutsche Bank is back in the news with something completely different, and the Bank of Korea has suspended their CBDC project. I can't imagine why. What could possibly cause a country to abandon their crappy surveillance coin? You can probably guess. And then Lolly. If you don't know what Lolly is, you will by the end of the show. They've been around for a long time, and it looks like they got bought out. Does that make them a sellout? I don't know. We'll talk about it. And Wallet of Satoshi is going to round us out. But first, let's get into the news that is the news that you can use. Judge lets Celsius's $4 billion Bitcoin lawsuit against Tether move forward. Amin Haskwanis has this one for Cointelegraph. A U.S. bankruptcy judge ruled that Celsius Network's multi-billion-dollar lawsuit against Tether can proceed, denying in part Tether's attempt to dismiss claims that it improperly liquidated Celsius's Bitcoin collateral during the crypto lender's collapse. According to court documents filed in New York on Monday, Celsius alleges that Tether executed a fire sale of over 39,500 Bitcoin in June of 2022, applying the proceeds against Celsius's $812 million debt without following agreed-upon procedures. Celsius claims Tether's actions breached their lending agreement, violated good faith and fair dealing under British Virgin Islands law, and constituted fraudulent and preferential transfers avoidable under the U.S. Bankruptcy Code. The complaint centers on a margin call Tether issued as Bitcoin prices plunged. Celsius argues that Tether sold its collateral before a 10-hour waiting period, liquidating the Bitcoin at an average price of $20,656, which was well below market levels, and later transferring the assets to its own Bitfinex account. I don't know, it just sounds like they made a margin call to me, but anyway, the filing alleges that Tether's liquidation cost Celsius over $4 billion worth of Bitcoin at current prices. Well, maybe you shouldn't have been defrauding all of your customers. I'm just saying. Celsius further claims that Tether's actions involved U.S.-based communications, personal and financial accounts, establishing sufficient ties for U.S. jurisdiction despite Tether's incorporation in the British Virgin Islands and Hong Kong. The judge agreed Celsius made a plausible case that the transfers and alleged misconduct were domestic in nature, rejecting Tether's arguments that the claim represents an impermissible extraterritorial application of United States bankruptcy law. In August of 2024, Tether sought to dismiss the lawsuit entirely, claiming that the U.S. court lacked jurisdiction and that Celsius's allegations fail to state valid claims. While the court dismissed some counts, it allowed Celsius's key breach of contract, fraudulent transfer, and preference claims to proceed, and those are the most harsh, by the way. Celsius, once among crypto's largest lenders, officially exited bankruptcy January the 31st, 2024, after an 18-month restructuring process, and the company is now in the process of repaying its creditors. In June, Tether CEO Paulo Ardoino said that the company has no plans to go public. Ardoino responded to speculation about a potential Tether IPO, dismissing the idea even as observers suggested that a public offering could value the stablecoin giant at over $500 billion, larger than corporations like Costco and Coca-Cola. While calling a $515 billion valuation a beautiful number, Ardoino suggested it might even undervalue Tether, considering its sizable Bitcoin and gold reserves. And meanwhile, Tether continues to expand its Bitcoin footprint, becoming the majority owner of Jack Mallers 21 Capital, now the world's third largest corporate Bitcoin holder. Tether recently transferred nearly 37,230 BTC, worth about $4 billion, to addresses tied to that platform. That's, I guess, a little aside for this story. I think that this is knives out on Tether from the United States judicial standpoint. I have made on several occasions, I've made the argument that Tether is going to be the United States go-to to transfer debt that is created in the United States to the rest of the world, and Circle is going to be their domestic stablecoin partner. So why on earth would the United States do this? I kind of think that it's a semblance of, to make it look like that they're really, that they're really not looking at Tether the way that I think that they're looking at Tether, like they're a partner to float United States debt to the rest of the world. I think it's like, I honestly kind of think it's just, I kind of think it's a play. Like it's set dressing. Like it's, oh, we couldn't possibly, just go through with our plan to float a whole bunch of debt through Tether to the rest of the world because they're not incorporated in the United States. So I know we'll make it look like we're really going to be coming down hard on them. I kind of think that that's what it is, because Tether is the one place in the world, it's the one company in the world that would allow the United States to transfer enormous amounts of freshly printed debt instrumentation outside the United States. Now, that said, Circle is definitely vying for position in the stablecoin market. There's just no two ways about it. And Jeremy Allaire and his little band of merry miscreants are not stupid. They're conniving, they're crafty, they're fairly sinister, and they're well positioned to actually do something like that. So it would not surprise me whatsoever if they aren't going to work the leverage on their side of the United States judicial system to do everything that they can to hurt Tether. And honestly, I don't think it's going to work. If we get into the particulars of this case, this Celsius Celsius versus Tether, I honestly don't think that Celsius really has a leg to stand on unless it can be proven beyond a shadow of a doubt two things: that the 10-hour deadline was in fact part of the deal, and everybody signed that deal, and nobody can escape the fact that everybody signed that deal, and Tether pulled the trigger prematurely and sold all the Bitcoin before that 10-hour deadline. We don't know. We're not part of discovery. We're not part of the lawyer teams. We have no idea what that agreement actually looks like. And we don't know if Tether actually breached that agreement. Here's the thing though. If they did breach the agreement and they have to pony up $4 billion, which I don't think, even if they are found guilty, I don't think they're going to have to pony up $4 billion, because Tether would only be on the hook for what damages was done at the time of the sale. At least that's my take on it. Nobody knew at the time. Nobody had a crystal ball at the time to tell them that we were going to be looking at $105,000 Bitcoin right now. So I don't think that they'd be on the hook for the full $4 billion. That's a lot of F's in there. Even if they were, guess what? They can do that. Tether made $13 billion with 200 people last year. That was net revenue, not gross. That was net revenue, $13 billion. They're sitting on more money than they really know what to do with. I also agree with Paolo Ardoino. Paolo Ardoino. I am having some difficulty speaking this morning. Sorry, y'all. I think that Tether probably is more valuable than Coca-Cola at this point. I think it probably is more valuable than a lot of $500 billion companies. It's not that I like them, but I also don't hate them. I'm rather neutral on them, except that it's a fascinating story. From that standpoint, I love the story. But we've got yet other fish to fry, and these fish are much older. From Decrypt and Connor Sefton, UK pension firm sees growing interest in Bitcoin exposure. A financial firm that enabled a UK pension fund to put Bitcoin on its balance sheet told Decrypt that it's seeing growing interest from other clients. Arash Nasri, a senior investment consultant at Cartwright Pension Trusts, also revealed that wider industry reaction has been surprisingly positive. The company helped an unnamed British client make a 3% allocation to the world's largest cryptocurrency in November of 2024. And according to Nasri, it secured a 60% return on investment in under 12 months. That's almost unheard of, guys. Cartwright has now launched its first ever annual Bitcoin review, which is designed to raise awareness within the institutional community. When asked whether the pioneering pension fund would consider increasing its BTC allocation moving forward, Nasri said, quote, "If Bitcoin continues to produce the returns we anticipate, the decision will more likely be, when should we trim?" End quote. He added that discussions are ongoing with several other clients about following suit, but it's crucial for pension funds to be fully informed about how Bitcoin works and gradually build up an allocation with a long-term outlook. Stressing that Cartwright doesn't have any, quote, skin in the game, Nasri stressed, quote, "We are independent advisors who have built a deep understanding of the potential impact of Bitcoin in coming years on individuals, companies, asset owners, and governments. We see it as our fiduciary duty to investors to raise awareness." The investment consultant admitted that there has been pushback from some skeptics within the British pensions industry saying, quote, "A common retort has been that Bitcoin's price is too volatile. This is disappointing to hear, as our industry should be experts in portfolio construction and position sizing." He also spoke out against a lack of willingness for many in our industry to learn about an emerging form of money and a new technology which could, parentheses will, in our view, in parentheses, be hugely impactful to an investment portfolio and future returns. Nasri then told Decrypt that Cartwright hasn't just been encountering growing interest from pension schemes. Corporations are beginning to learn how Bitcoin can be used for 24/7 cross-border transactions and help as a reserve asset, while charities are increasingly seeing it as another source for donations. Nonetheless, he stressed that Bitcoin might not be suitable for everyone. Quote, "Bitcoin in a portfolio is not appropriate where the investment time horizon is short, but that still leaves hundreds of defined benefit schemes, all defined contribution schemes, and most charities and companies that should be having a serious conversation about it," he said. So here we have this company who advises pension funds on what to buy. And Cartwright, that's the name of this company, advised an unknown British pension fund to put 3% of all of their shit into Bitcoin. And lo and behold, inside of 12 months, they had a 60% return on that 3%, which probably completely destroyed the rest of the portfolio, at least in terms of performance. So what does that pension company do moving forward? They're probably kind of freaking out, honestly. You would think that I would say, well, they're going to clearly buy more Bitcoin. No, probably not. They're probably going to sit on what they have, and it's probably going to continuously destroy, in terms of performance, the rest of their portfolio. But the good news is that there's a bunch of other companies that are saying, hey, we want some of that. We want some of that. And it's not just other pension funds. It's charities that are asking questions. It's corporations that are asking questions. Cartwright looks like they may end up being a very well-positioned company for consulting just on Bitcoin and digital assets going into the future. But you know who else is moving into the future? And this is the one that I'm honestly, I don't know why I'm so excited about this one, but I just am. And it's probably because I spent 10 years in a room full of web developers, and all of them at one point or another, hell, even my wife, hell, even my son has been playing with Figma. Now, what is Figma? It's a design software, and most of the people that I see using Figma use it to design what the front end application on an iPhone or an Android or a website is going to look like. It doesn't build the thing. It just helps people look at where should buttons be placed on this iPhone app. And it allows you to visually design what that thing is going to look like, so that you start showing it to people and say, do you like where this button is? Figma, turns out, is one of the go-to software design packages that has ever been built. Not everybody, but so many people that are doing software and application construction, so many of those people use Figma. It's almost as if it's a standard in your toolkit. And Figma has just revealed that they own $70 million of the Bitcoin ETFs and plan to buy $30 million more. Yes, I know they're not holding it themselves, but hey, it's a step in the right direction for Figma. Oscar Perez out of Bitcoin Magazine tell us more. Design platform Figma revealed in a new SEC filing that it owns $70 million in Bitcoin ETFs and was approved to buy $30 million more. The disclosure came as part of Figma's S1 filing released alongside its bid to go public. Figma held $78.8 million in a Bitcoin exchange-traded fund as of December 31st, 2024, categorized as a level 1 asset. As of March 31st, 2025, the value declined to $69.5 million, which included in its $1.5 billion total of cash equivalents, and marketable securities. Quote, "We have an investment in a Bitcoin exchange-traded fund," said the filing document. The fair value of this investment was $69.5 million as of March 31st, 2025. Changes in the fair value of this exchange-traded fund are impacted by the volatility of Bitcoin and changes in general economic conditions, among other factors. On March 3rd, 2024, the board of directors approved an investment of $55 million into a Bitcoin exchange-traded fund investment operated by Bitwise. So they didn't go for BlackRock, they went to Bitwise. And that's really important. Bitwise, if I remember correctly, it's Bitwise that gives a standing 10% of their earnings to OpenSats as charitable contribution for the development of Bitcoin and other freedom-oriented, free and open source software projects. BlackRock does not. Most of the other ETFs do not. Bitwise does. And that's why it's really interesting that Figma chose Bitwise for their investment holder. Anyway, quote, "The investment is classified as an equity security within marketable securities for the periods presented. On May the 8th, 2025, the company's board approved an additional $30 million investment in Bitcoin. Following the approval, Figma purchased $30 million worth of the stablecoin USDC with plans to convert it into Bitcoin at a later date. The filing notes the ETF's volatility, but also states no credit losses have been recorded on the asset. Figma reported $23.8 million in unrealized gains from equity investments for the year ending December 31st, 2024, and $0.3 million quarter one 2024. However, it recognized a $9.3 million of unrealized losses in the first quarter of this year. Interest income from cash equivalents, and marketable securities totaled $63.7 million in 2024 and $15.5 million in the first quarter of this year. So it looks to me like they have $78.8 million in a Bitcoin exchange traded fund, and then that dropped to $69.5 million. Oh, boo-hoo, because they bought it for $55 million, so they are still making out like bandits. And they are just about to throw $30 million more. And the fact that Figma has absolutely nothing to do at all with Bitcoin or cryptocurrency in any development way, other than the fact that developers probably, like I'm sure JB55, the creator of Damus, which is a nostr client, I guarantee you he uses Figma. I guarantee you the developers all over nostr use Figma. I guarantee you the developers all over the world use Figma. And while some of them are using it to maybe build the front ends of Bitcoin wallets, Figma itself has nothing to do with cryptocurrency other than the fact that now we know they own a shit ton of it. And Figma is nothing to shake a stick at. That's one of the reasons why I'm so excited. I'm so excited I'm drooling on myself, and I might need a nice bar of soap to get it off. You can get your soaps at SoapMiner.com. It's handmade tallow soap, ladies and gentlemen. It's got almost nothing in it, except all the things that make up good soap. For instance, let's see, the rough cut tallow soap bar is 5 ounces, $7. It has the following ingredients: 100% pure grass-fed beef tallow, sodium hydroxide, otherwise known as lye, and distilled water. Is that clean enough for you? Is that devoid of parabens enough for you? Is that devoid of red food dye number 5 and blue lake number 6 artificial colorings? Is that devoid enough of the bullshit for you? Because I'm not sure if you can actually make soap with anything less than fat, lye, and water. This soap lasts forever. I got a family of 4. It took weeks for us to get through this single 5-ounce bar of rough cut tallow soap. And SoapMiner takes Bitcoin. If you're not taking Bitcoin for your goods and service, you're not in the Circle P. The Circle P is where I bring plebs just like you that have goods and services for sale to plebs just like you who want to buy those goods and services in Bitcoin. SoapMiner takes Bitcoin. Go to SoapMiner.com. SoapMiner.com. Get you a bar of soap that's going to last your family for weeks. You can not only get a rough cut tallow bar if you want Earl Grey tallow soap bars, he's got it. He's got goat's milk tallow, he's got lemongrass, he's got orange clove, he's got redacted, which is a really cool soap. I should be getting mine at one point or another, but it's carbon, pumice, lye, beef tallow, and water. I mean, the other stuff that he's got is tea tree. He's got pine tar tallow soaps. He's got cedar wood. He's got peppermint. He's got lavender. The man is a one-stop shop for soap. Go to SoapMiner.com, and if you want 10% off, use the code Bitcoin. And because that tells SoapMiner that I made a sale for him, and in the value for value advertising model, SoapMiner then and only then pays me what he thinks that sale was worth to him. Let's move on to absolute and utter stupidity. Arizona governor has vetoed the bill to stockpile seized crypto. Martin Young from Cointelegraph. The governor of Arizona has rejected a bill that would have seen the United States state hold on to seized crypto assets in a fund. Arizona Governor Katie Hobbs vetoed House Bill 2324 on Tuesday, stating in a letter that it disincentivizes local enforcement from working with the state on digital asset forfeiture by removing seized assets from local jurisdictions. It's a fucking mafia. Hey, man, as a street boss, Your Highness, our neighborhood over here, we were stealing that money fair and square. You as the big boss, you just taking it away from us. We don't want to work the streets anymore for you, boss. That's exactly what this shit is. This is just street level mafia bullshit. Anyway, the state's House voted the bill down during its third reading in May, but the Senate revived it in a reconsideration vote last month, and the measure was then passed by the House in a 34-22 vote on June the 24th. The governor's veto could be overridden with a 2/3 vote by both the House and the Senate, but that appears unlikely to happen unless some lawmakers switch their vote. The bill would have created a Bitcoin and digital assets reserve fund to manage any digital assets forfeited to the state. Katie Hobbs' veto letter from HB 2324. Oh, I'm sorry. I totally wronged on that one and read something I wasn't supposed to read. The bill stipulated that the first $300,000 worth of crypto in a criminal forfeiture would go to the Attorney General's office, and any amount over that would have been split 50-50 or 50% with the AG and 25% to the State General Fund and 25% to the new reserve fund. Hobbs has voted other crypto bills or vetoed other crypto bills that have made their way through the state's House and Senate because in May, if you remember, and I told you about it, she vetoed Senate Bill 1025, which would have created the Arizona Strategic Bitcoin Reserve and allowed the state treasurer to invest up to 10% in Bitcoin, saying cryptocurrencies are, quote, untested investments. Yes, that you're much smarter than the guys at BlackRock. You're just brilliant, Katie. I'm surprised that you're not a trillionaire already. She also vetoed Senate Bill 1373, a strategic digital asset reserve bill that would have allowed the state to create a treasury from seized assets. 3 crypto bills, 3 bills have now been rejected by the Arizona governor, and only one has made it through. Arizona House Bill 2749, enacted in May, amends state statutes to integrate crypto assets into Arizona's financial and unclaimed property frameworks by establishing the Bitcoin and Digital Assets Reserve Fund, which is managed by the state treasurer. And then they start talking about all the other states. And we're going to talk about one of the other states right now. This is one of the states that decided to take a cig out of their holster and load one in the chamber and point it directly to their head and pull that trigger. Connecticut has approved a law prohibiting crypto use in government. Yes, you're not allowed to use crypto in the government. This is Cointelegraph. It's written by Turner Wright. Connecticut Governor Ned Lamont has signed a bill into law restricting the use of digital assets in state government, including the establishment of a cryptocurrency reserve. On Monday, Lamont signed Connecticut House Bill 7082, which was previously approved by the state's House of Representatives as well as the Senate. The legislation specifically prohibits the state government from accepting or requiring payment in the form of virtual currency or purchasing, holding, investing in, or establishing a crypto reserve. The bill, introduced in February by State Rep. Jason Duchette, also establishes requirements for crypto money transmission licensees in Connecticut. The provisions barring the state government from accepting crypto or establishing a digital asset reserve take effect on October the 1st. And legislation in the Connecticut state government marked a different path from that of several U.S. states exploring the establishment of Bitcoin reserves. Cointelegraph reached out to Duchette for comment, but he hadn't said anything. Brogan Law founder Aaron Brogan told Cointelegraph in June that the bill was a reflection of the divide between some Democrats and Republicans on digital assets, likely because of the nationalized debate with U.S. President Donald Trump's connections to the cryptocurrency industry. He said the bill would do nothing of substance. Quote, "This is signaling that Connecticut is symbolically opposed to cryptocurrency and to all the states that have established Bitcoin reserves," said Brogan. And then they start talking about other United States, but we don't need to talk about that. We have numbers to run. Futures and commodities. But first, Trump announces a Vietnam trade deal. He's slapping a 20% tariff on Vietnam's imports to the United States. Yay! Oil. West Texas Intermediate is up 1.6% to 66.52. Brent North Sea up the same to 68.23. Natural gas, however, is up almost 2 full points to $3.48 per thousand, and gasoline is up a quarter to $2 and a dime. Gold and all of its shiny metal brethren are all in the green today. Gold itself is up a quarter of a point to 33.57 and 3 dimes. Silver is up 3/4 of a point. Platinum, however, swinging for the fences, just over 5% in the green. Copper is up 2 points. Palladium is up 4 3/4. Meanwhile, ag is mostly in the green today. Biggest winner looks to be soybeans, 1 1/4 to the upside. Biggest loser is sugar, 1 1/2 to the downside. Meanwhile, live cattle crab walking sideways in the red. Lean hogs up, what is that number? 1/4%. And feeder cattle are up 0.18%. Meanwhile, the Dow is down 1/10 of a point, but the S&P is up 1/4. NASDAQ is up 1/2, and the S&P Mini is up 1/3 of a point. Moving on. Oh, wait a minute. Wait, no, actually, I'm sorry. I put this here for a reason. Before we do Clark Moody, let's talk about this one from William Suber, Cointelegraph. Bitcoin squeezes shorts in $108,000 spike as the United States jobs report drops most in 2 years. By the way, we are now at 109,560. You're going to ask, why is this important? Just hang on, because the jobs report is a deal. All right. So Bitcoin touched 108,000 at the July 2nd Wall Street Open as a major miss in United States employment sparked volatility. Data from Cointelegraph Markets Pro and TradingView showed Bitcoin up 2% on the day, and gains accompanied a surprise reaction in private sector payrolls data, which came in 33,000 lower in June to hit its lowest level since March of 2023. Estimates from management firm Automatic Data Processing, which compiled the data in its National Employment Report, has seen an increase of nearly 100,000. Quote, "Though layoffs continue to be rare, a hesitancy to hire and a reluctance to replace departing workers led to job losses last month," ADP chief economist Neela Richardson commented. Ahead of U.S. non-farm payrolls data, which is due to be released July the 3rd, crypto market commentators were optimistic. Labor market weakness, they noted, increased the odds of Federal Reserve interest rates coming sooner rather than later, a key source of liquidity injections for Bitcoin, altcoins, and the raft that we know as risk assets. Quote, "Fed rate cuts are becoming increasingly likely in July," Andre Dragosh, European head of research at crypto asset manager Bitwise, wrote in part of a response on Twitter. As Cointelegraph continues to report, Fed officials' resistance to rate cuts has spawned pushback from Washington, including from Donald Trump himself, who this week demanded that rates fall to 1% or lower. Oh my God. Could you imagine a move from 4.25 to 4.5%, which is what we got right now, to fall all in one shot to 1%? You want to talk about $220,000 Bitcoin? That would do it. Actually, that would probably go to $250,000. Anyway, the latest data from CME Group's FedWatch tool shows market sentiment unchanged by the ADP numbers, with the Fed September meeting still the favorite for the next cut being unveiled. Yeah, don't hold your breath. Don't hold your breath. We're going to have to wait and see, because I talked about it yesterday. Jerome Powell's got all the ammunition that he needs. Even with the weak jobs report, he still is sitting in the catbird seat, being able to tell Donald Trump to go sit and spin, or pound sand, or shove your thumb up your ass, whichever way you want to go. He has the creds at this point to say, nope, we're not cutting. And one single jobs report, in my opinion, is not enough to change his mind. But he may. You never know. Anyway, we got Orange Coin at 109,400. That is a $2.18 trillion market cap. And we can get 32.6 ounces of shiny metal rocks with our one Bitcoin, of which there are 19,886,316 and a half of. And average fees per block are low, 0.03 BTC, taken in fees on a per block basis. There are all of 2 blocks carrying 3,700 unconfirmed transactions waiting to clear at high priority rates of 3 Satoshis per VByte. Low priority is going to get you in at 1. And mining has dropped a little bit. We're back down to 875.2 exahashes per second. Most likely it's because a heat bubble just will not move. It's unrelenting. And from what I understand, it moved from the southeast and east coast, moved west into the Midwest, and it looks like Texas is baking in the sun. That's the one part of Texas that I don't miss, is the summers. I've always hated the summers. It's like I loved them as a kid because I was out of school, and when you're a kid, you don't notice the heat. But when you're past the age of 25, 106 degrees feels pretty freaking awful. It just does. It makes me wait for an easy breezy, which was the name of Bitcoin Ann's yesterday's show. Turkey with 5,000 said something. He says, the turkey has left the roost. I'll be back next week. See you later, turkey. Safe travels. Don't get baked. Okay. Well, Progressively Worse with 555 says, here's a little boosty boost to go alongside the other boosting boosters that have boosted many boosts. Boost. Yodel with 511 had something good to say earlier, but forgot. Hi, everybody. FOMO Chronic with 320 has a couple of emojis. God's Death with 237 says, thanking you, sir. He actually spells it thanking you. Thanking you. Frankenstein. I might have to play with that a little bit. Anyway, that's the weather report. Welcome to part 2 of the news that you can use, and Deutsche Bank is back in the news. Deutsche Bank's DWS Galaxy Flow Traders venture to introduce German regulated stablecoin. Yeah, there you go. Ian Allison's got it for CoinDesk. A joint venture between Deutsche Bank's asset management subsidiary DWS, Flow Traders, and Galaxy said that it will issue Germany's first regulated euro-denominated stablecoin after receiving an e-money institution license from the Federal Financial Supervisory Authority, also known as BaFin, this week. The All-Unity EURAU, the All-Unity Euro. My God almighty, these names. The All-Unity Euro stablecoin, which will comply with Europe's Markets and Crypto Assets, or MiCA framework, was tested by the companies back in December of 2023. Wow. EURAU, or whatever, will be 100% collateralized and deliver institutional-grade transparency through proof of reserves. Oh, interesting. And regulatory reporting, according to a release. The token can be used for 24/7 instant cross-border settlements, seamless integration for related financial institutions, fintechs, treasuries, and enterprise clients all across Europe and beyond, all Unity said. The stablecoin joins a growing number of euro-pegged tokens, including those that have popped up since MiCA took effect about a year ago. They include Circle's EURC and Societe Generale's EURCV, alongside MiCA-compliant dollar coins such as SocGen's USDCV and Robinhood's backed global dollar USDG. Good Lord, the acronym. Speaking about securing an EMI license from BaFin, Alexander Hopner, CEO of All Unity, said in a statement, quote, "This license is not just a regulatory hurdle cleared, it's a foundational step towards building a truly secure, transparent, and compliant digital cross-border payment ecosystem for Europe and the global markets," end quote. And that's it. So Deutsche Bank, on the heels of yesterday's news of, custodying Bitcoin for clients, is now getting into this, is immediately jumping into the stablecoin pool with their subsidiary. It'll be an interesting play. And again, not to beat a dead horse, but the question becomes, will Tether bend the knee to MiCA and become MiCA compliant and hold 60% of their reserves in European central banks so that they can have Tether as part of a MiCA compliant stablecoin ecosystem in Europe? I actually hope not. I really hope they don't. I hope they go after the rest of the world. Let Circle have the United States and Europe, because the world is an awfully big place. And honestly, there's more growth outside of the West than there is inside the West. If you want to bet on horses, I wouldn't bet on the crippled one, is all I'm saying. I mean, I got to be truthful here. Bank of Korea has suspended their own CBDC project as won-backed stablecoins gain momentum. Atlas 21 is going to tell us all about it. The Bank of Korea has announced the temporary suspension of its CBDC project. According to Yonhap News, the central bank recently informed participating banks in the Hangang CBDC project of its decision to postpone discussions on the second phase of the digital currency testing. The pause comes less than 3 months after the pilot program's launch. So 3 months and they're already going, dude, stablecoins. Anyway, it involved 100,000 citizens using the CBDC with local merchants and partnerships with the companies or the country's major banks. The first phase of the pilot is expected to conclude by the end of this month. The Bank of Korea's decision coincides with growing interest in stablecoins pegged to the local currency. Newly elected President Lee Jae-myung has pledged to legalize the issuance of won-backed stablecoins, which are currently banned, and to foster a domestic market for these digital assets to help prevent capital flight. Min Byung-deok, a lawmaker from the ruling party who led digital asset policy during the presidential campaign, has proposed legislation to establish a licensing framework and regulatory requirements for potential stablecoin issuers. Kakao and Naver, South Korea's two largest technology firms, have filed trademark applications for stablecoins via their mobile payment platforms. God, this is going to get so weird so fast. According to local sources, 8 of the country's top banks are reportedly planning a joint venture to issue a won-backed stablecoin. Despite the CBDC's project suspension, the Bank of Korea has expressed a favorable stance towards won-denominated stablecoins. Governor Lee Chang-yong stated that he sees a need for such assets provided that adequate risk management measures are in place. One factor behind the decision to suspend the CBDC initiative was the financial burden on participating banks. According to reports, the pilot program imposed, significant costs on local institutions, particularly in the absence of a concrete implementation plan. On average, each of the 7 participating banks spent 5 billion won, which is about $3.7 million US on the project. You know what that means. But even banks they all know that they cannot compete on the technology side. These institutions, they were doing well to try to keep up with, internet routings and switches and servers and server rooms and the air conditioning cost and buying power stuff. I mean, there's a whole host of shit that goes on behind the scenes when an institution of any size has to not only come into the computer age, but remain there. It takes an entire IT department. Did you know that there was no such thing as an IT department in most companies not more than 30 years ago? Literally, 30 years ago, a great majority of companies, if you include all of them, small to medium to large, did not really jack around with IT. They had Bob in the corner office. Hey, Bob knows about computers. That's not the way this shit works anymore. And these guys, I guarantee you, their IT departments are struggling trying to keep up without even thinking about money, without even thinking about Bitcoin or stablecoins or CBDCs or nothing like that shit. Right? They're doing well to keep their servers from catching on fire and destroying customer data. They're making sure their email server is up. They're having problems. I guarantee you there are groups of people that are exhausted trying to keep up with all this shit. And then you got to go and get new equipment, which means that you have to evaluate new equipment. And it's a lot of strain. And now you're asking them to jump into CBDCs, stablecoins, and the world that we exist in. We built this fucking thing while everybody was pointing at us and laughing, and now they can't keep up. Governments can't keep up. Lawmakers can't keep up. The people that want to censor both our money and our words have no fucking hope of keeping up. None of these people are prepared for what's coming. None of them. And I'm here for it. Moving on to Thesis. Thesis acquires Lolli, Lolli, to expand their Bitcoin rewards ecosystem. Lolli, it was nice knowing you. I've been with Lolli for a long time. I've had their browser extension active in my browser for a long time. I was getting Bitcoin back on purchases every time that they had a vendor that participated in their program. And now Thesis has bought them out. Juan Galt, Bitcoin Magazine. Thesis, a Bitcoin-focused venture studio, announced its acquisition of Lolli, a Bitcoin rewards platform, in a move to integrate it with its broader ecosystem of companies such as Fold, Mezzo, and TBTC. Jesus, they've got Fold too. The announcement outlines plans to enhance consumer Bitcoin experiences through expanded rewards and brand new partnerships. Lolli, founded in 2018, claims to have rewarded over 600,000 users with more than $20 million worth of Bitcoin through shopping at 50,000 stores and playing 1,000 plus mobile games. Lolli's platform is designed to make Bitcoin accessible by offering cash back and rewards for everyday activities. Thesis, operating since 2014, has built Bitcoin native projects like Fold, which recently became a publicly traded Bitcoin financial services company under the leadership of Matt Lugano, its CEO and Fold's co-founder. Quote, having competed alongside Lolli for years, I've admired their ability to onboard users through accessible and engaging experiences. At Thesis, we believe Bitcoin's real growth is driven by everyday interactions, shopping, gaming, spending, not just investment portfolios, said Lugano, who will now lead Lolli's next phase. He added that Lolli's user base and rewards model align with its vision of driving Bitcoin adoption through practical use cases. Lolli's founder and former CEO Alex Adelman added, quote, We are excited to join forces with Thesis to power the next phase of Bitcoin adoption through rewards with Lolly. Thesis brings both deep infrastructure expertise and a shared vision, enabling us to significantly enhance our platform." End quote. Thesis believes this acquisition will address fragmentation in the Bitcoin consumer experience by uniting Lolly's rewards with Fold's financial services and its broader ecosystem. Thesis outlines several planned upgrades for Lolly under Lugano's leadership. It intends to enhance the arcade and daily stack features with more games, quests, larger rewards. A new Lolly market is in development, which seeks to offer more brands, higher cashback rates, and global accessibility. Thesis plans to introduce instant reward payouts later in 2025, responding to user demand for faster redemptions. Additionally, Lolly will collaborate with Fold on an expanded gift card marketplace to increase earning opportunities. For global reach, Lolly is now developing an international expansion strategy to bring Bitcoin rewards beyond the United States. To support these changes, Thesis plans to migrate Lolly to a more scalable infrastructure. The company claims that this will strengthen Lolly's ability to onboard new users and handle increased activity. Thesis sees this acquisition as a step towards a circular Bitcoin economy where earning and spending Bitcoin are seamless. It hopes that the integration of Lolly with Fold, Mezzo, and TBTC will close the gap between Bitcoin rewards and everyday use, making adoption easier for millions. So this is actually a lot bigger news than I initially thought. Fold, Mezzo, TBTC, and now Lolly under the same umbrella and all working together, if they can pull that off, because it's hard to bring teams that didn't build something together and have them actually work together for a common mission that they're all engaged in. It's difficult. It's a hard thing to do. However, if they pull this shit off, Thesis is going to be a large. It's going to be a thing to contend with for other people. I honestly think this is good news. If they don't screw this up, this could be fairly large. Which brings us to the end of today's show. Wallet of Satoshi partners with Spark to offer self-custodial Bitcoin Lightning experience. Wallet of Satoshi seems to be coming back, baby. Oscar Perez, also for Bitcoin Magazine, today. Spark has announced a brand spanking new integration with Wallet of Satoshi, one of the largest Bitcoin Lightning wallets, to bring users a truly self-custodial Lightning experience. It's in beta, according to a press release sent to Bitcoin Magazine. Quote, "From the start, Spark felt like the missing piece," stated Wallet of Satoshi. Quote, "It gave us the foundation to explore self-custody seriously, abstracting away the complex parts of self-custody so that we could stay focused on user experience." End quote. Being self-custodial, this will allow customers to have full control over their Bitcoin. In November of 2024, Wallet of Satoshi removed its app from the United States Apple and Google App Stores for unspecified reasons, although likely due to an unfavorable regulatory environment which was cracking down on Lightning wallets at the time. But now that the regulatory landscape has changed in the United States, Wallet of Satoshi stated this integration will unlock the ability to re-enter and serve the United States market. Wallet of Satoshi also faced limitations when developing its self-custodial Lightning wallet, such as liquidity requirements, node complexity, channel management cost. It all made it difficult to build a truly self-custodial LN wallet, but now Spark has provided them a solution. Quote, "We built Spark specifically to solve this exact problem," the company stated. Quote, "Spark abstracts away all of the complexity for wallets looking to implement Lightning. You don't need to spin up channels, worry about routing, pre-funding liquidity, or even think about managing nodes. Creating a Lightning wallet on Spark takes less than 6 lines of code. end quote. Wow. Spark stated that it will continue building out new features as the product evolves, and those interested in joining the beta can leave a comment on their X post requesting to join. On May the 22nd, Breeze and Spark partnered to launch a new implementation of the Breeze SDK built on Spark's Bitcoin native Layer 2 infrastructure. The SDK supports LNURL, Lightning addresses, real-time mobile notifications, and includes bindings for all major programming languages and frameworks. The collaboration gave developers tools to add Bitcoin payment features to apps used for monetization of social apps, cross-border remittances, and in-game currencies. One day earlier, Spark also partnered with Magic Eden to improve Bitcoin trading by addressing issues like slow transaction times, high fees, and poor user experience. The integration introduced a native settlement system aimed at making transactions faster and more cost-effective without using bridges or synthetic assets. So Spark is all over the place. And this is the second story where we're actually seeing a lot of partnerships starting to form again. And we see this, I see this in cycles, in the general Bitcoin cycles. After, and I'm not going to say that this bull run is over. I don't want to say it either way. I mean, it's not all that important. But there are times during cycles where you get a bunch of companies that kind of do similar things, and all of a sudden they kind of collapse into each other and form like a bigger thing. It's sort of like the event horizon of a black hole. You just need to lose a little bit of velocity to fall into the black hole itself and become something different. And it looks like we are in that phase of the cycle again. And good. Competition is always good, but one of the ways that people regulate competition is by either buying somebody or forming a merger with somebody else. It's not always about we have to be enemies. It's not always about we have competing products that do the exact same thing, so we're going to, tell everybody on social media that you suck and we're great. But there's a lot of times when companies look at each other and go, you guys are really good at doing this. We're really good at doing this. If we were to have a little party together, we might find that we have a lot more to offer each other than being straight up competitors. Sometimes that's good. Sometimes it's bad. And when it gets bad is when there's so much conglomeration that you get like two companies that collapse into each other, and then, two other companies collapse into each other, and then those two entities come together, and what was 4 now becomes 1, and what was 8 becomes 1, and do the math. It becomes geometric. And then you start getting into things like behemoths, like Coca-Cola, Johnson & Johnson. That happened. That's how those companies got where they are. That's why they're so big and, in my opinion, completely unmanageable. There's a reason why insects don't become giants. I've talked about this before, but I think I should bring it up again. There's a sweet spot for everything relative not only to its size but to its environment. Its size of a creature is connected to its environment for various reasons. In the insect world, like when you were a kid, or when some of us were kids, we saw dinosaur books. And if they were written before, 1980, sometimes they'd have a depiction of a giant dragonfly that was like 4 foot long and, weighed like 12 pounds or something like that. It's bullshit. Insects cannot grow that big, and there's a reason why. They don't have lungs. Blue whales and elephants are maxing out a single creature's size specifications when it comes to the environment on Earth, both terrestrial and in the sea. But they got lungs. They've got beating hearts that pump oxygenated blood-like material around their tissues so that necrosis or tissue death doesn't start happening, right? There's active maneuvering going on there. But in an insect, you can only get so big because there's no lungs and there's no there may be a kind of like a little bit of a heartbeat kind of thing, but it's not really. It's just maybe there's like a faux circulatory system, but not like what we're talking about, like with a human or a squirrel or an elephant, right? But it still needs oxygen. All right, so how the hell do you make sure that you don't get cell death because you're starving cells of oxygen in something that doesn't have lungs and almost no circulatory system whatsoever? Diffusion, gas diffusion. An insect's size is mediated not only by its shape and the amount of surface area that it has as a relationship to the volume of its body, but where it exists. What temperatures does it normally, encounter? What pressure does it normally encounter? You know why you don't see insects at high altitudes? Can't survive there. They cannot survive there. There's not enough oxygen to diffuse through their, whatever their outside layer is, into the juicy body bits that oxygenate all the cells of their body. That's why you don't see mosquitoes past, I don't know, like 10,000, 12,000 feet, whatever. There's a limit, right? There's a limit to the smallest insect. And as you move up in altitude, it's the smaller and smaller insects, where the larger and larger insects are able to exist, all the way down to sea level because there's enough pressure to force oxygen into the volume of the body. I look at that as a metaphor or a model that we should look at companies. If the company gets too big and it does not have good functional circulation, in this case of information and possibly even cash flow, which is another type of information, and it doesn't have like a mechanical way to ingest the gases that it needs, in this case, let's call it, again, information and money, right? It's going to start faltering. It's going to start dying. And that's what I see happening with things like Unilever, Johnson & Johnson, Coca-Cola, PepsiCo, basically the food companies. Even the banking companies are getting so big that that one side has literally no idea what the other side is doing. So you got JP Morgan that sends different messages. We love Bitcoin. Well, except Jamie Dimon comes out and says the government's going to shut Bitcoin down in 10 years. But they offer Bitcoin services. It doesn't make any sense. That's not exactly the way that I'm thinking when companies falter. Generally speaking, it usually starts in customer service, i.e. terrible customer service. That's when you really know that a company is getting way too big, because customer service starts to become, I don't know, like an add-on and not a primary driver of the future of your business, which it is. If somebody's not happy with your service or product, you better fucking address it. Otherwise, they're going to go find somebody else. But when you're AT&T, you don't have a whole lot of options, ladies and gentlemen. And even if you do, AT&T's got so much of the market, they don't need to worry about their customer service as much as, I don't know, MCI would have had to, or Sprint has to now. And even they suck at it because they're big enough to suck at it. So what I'm getting at is that we're seeing the same kind of consolidation that any other industry sees. It's a fight for efficiency, but in that fight for efficiency, you start getting shitty customer service. So if you're a Bitcoiner out there and you're looking at saying, hey, I loved Lolly, I loved Fold, and now they're going to be under one umbrella. If they start screwing up customer service, you need to be very loud about how they're screwing up their customer service. Otherwise, we're going to end up with the AT&T of Bitcoin, and nobody wants that. I'll see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.